So our talk today is entitled Home Builders Defense Contractors. And it's a summary of what we think the home building industry has evolved into post-COVID. And hopefully I can change my slides here, but for some reason they're not advancing. Let's do that. There they are. Okay. Our take is that the United States is not in a recession or a depression or an expansion or a recovery. What we're in is a wartime economy. Americans are being asked to sacrifice their normal lives to fight a foe, and that foe is COVID. Now, the heroes that we have as we do in war are the frontline healthcare workers and those who are working to stop the spread of the pandemic, but really it's all of us too. We're all soldiers too. We're citizen soldiers. We're at risk. How do we protect ourselves? Well, one of the ways is with a fortress. And that's where home builders come in, because we see builders as having evolved into an industry that is now not just building a consumer good, which is a house, but building fortresses for citizen soldiers. And that makes them, as we describe in our work, defense contractors. So why does this analogy, the wartime economy and defense contractors, matter? And what we see is 5 things that are happening to support demand for housing. One is homes are safe havens. And as such, they are inherently worth more to consumers than they were pre-pandemic, both as protection from COVID and for certain white-collar workers as places of work. Second, we have a shortage. We have a supply shortage, as we often do in war, of fortresses and also for the goods that make fortresses, which creates input cost rises. Third, we have government support for the war effort, meaning specifically for housing, easy monetary policy and business closure exemptions that I think are likely to really help the industry if we see a return of the pandemic in a more significant negative way. Fourth, we have rationing, meaning consumers have fewer expenditure options, things they can't buy. That benefits savings rates, which helps down payments, and it funnels expenditures toward housing. And then last, citizen soldiers have become refugees. We don't call it deurbanization. We like to refer to it as de-densification, meaning decamping from urban cores to suburban and exurban locations, and that benefits the single-family housing market. So this is why we think this analogy is important. All 5 of these elements are helping home builders, and we think will continue to. So Liz referred to the survey that we've done with HomeSphere now going on, I think, 4 years now. Every month we do a survey of anywhere between basically 75 and 100 mid-sized builders all over the country. We ask a number of questions, and I'm going to show 2 slides from our recent survey. We ask every month, are your sales up or down versus last year, your new sales contracts? And as you can see, if we look back to April of 2020, we had a very low number of builders who thought their contracts were up, and almost half said they were down. Well, look at the change. By August of 20, we're seeing 70% or so of builders say their sales contracts are up and only 9% are down. And that's per community. So that it doesn't matter how many new communities you've opened. That's just absorption rates on a per community basis. So the strength had really been remarkable. In addition to that, we're seeing record levels of pricing. So this graph is a function of, we asked builders, have you raised your base prices, all of them, or raised some, lowered others? Have you kept them unchanged? Have you lowered them? And 51% of the builders that we surveyed in August said they'd raised most or all of their base prices. That's a record for our survey. A very few are lowering them, effectively almost none. And only 20% are keeping them flat. So there's a few reasons for this. One is input costs, but second is demand. And that's what we're really going to talk about. So this is how the data rolls out in terms of national new home sales. This is just the last year or so. And the dark blue line is the new home sales SAR. The last print just a few days ago was 1 million new home sales on a seasonally adjusted annual rate basis. That's really remarkable given that we were at 600,000 in April. And the seasonally adjusted annual rate is now growing around 40% year over year. So again, these are remarkable changes. These are bottom of cycle recovery type changes, and they're not off of a low base. We've also seen sentiment among home builders look especially strong. And this is the entire housing cycle since the bubble. So basically, 2011 all the way up to 2020. And we're at record high levels in terms of home builder sentiment. So the dark blue line is the sentiment read. It's near 80. That's not quite an all-time high, but it's an all-time high for this particular cycle. And the elements of the index, whether they're next 6 months sales or sales that are presently occurring or traffic, are all near highs for the cycle. This is remarkable. There are very few other industries in America that are going to show charts like this. So why is this happening? As we said, 5 reasons connected to the wartime economy. First, homes are safe havens, and that means they're worth more to the consumer. Consumer sentiment data we track very carefully from University of Michigan. And what we've noticed in the data is that single-family homes, as the consumer perceives them, are now a better value than they were pre-pandemic, despite the fact that prices has risen. This is an important change, a really important change, because consumers leading up into the pandemic had started to increasingly perceive that home prices were too high. And that actually hurt sales activity in 18 and into early 19. Builders started to reduce prices somewhat and demand came back. But all of a sudden, post-pandemic, consumers think homes are cheap. Well, virus protection is one element of that. But in addition, space devoted to work for white-collar workers, so often the customers for builders, and the dollars and time saved from commutes all add to the perceived value of the unit. So the bottom line for us is that we think home prices are going to continue to rise through the pandemic, and we expect builder pricing power to remain strong. So this is one of the charts that we've shown in many of the presentations that we've done at HomeSphere events, and we show our customers all the time. This is the University of Michigan. Every month asks consumers, do you think it's a good time to buy a house, or do you think it's a bad time to buy a house? And then the survey asks, why do you say so? And so we look at the difference between the number of builders or the number of customers, consumers who answer the survey, who think it's a good time to buy because prices are low versus it's a bad time to buy because prices are high. So when this graph is above 0, it means consumers think it's a good time to buy because prices are low, or the majority of them think that. So notice that basically from 2018 on up to right at the pandemic, a larger number of consumers in Michigan survey thought that it was a bad time to buy because prices were high, then thought it was a good time to buy because prices were low. But look what's happened. All of a sudden at the pandemic, we've seen a huge spike up at basically levels that we haven't seen since 2016 or so in the percentage of consumers surveyed who think homes are a value now. Now we've seen them come down a little bit since say July, but this number still being above 0 is an important tell for us. Another way we look at this, and we really like to determine cycle tops in housing with this data. I mentioned you can tell the University of Michigan that I think it's a good time to buy because, and there's a series of reasons you can choose. One of them is prices are low, but there's 3 others that are important. One is you think it's a good time to buy because interest rates are rising. You want to beat rates. You think it's a good time to buy because prices are rising. You want to beat price. Or you think it's a good time to buy because housing is a good investment. Those 3 reasons are what we call urgency reasons. We also call them fear and greed reasons, meaning consumers think it's a good time to buy because they want to beat change or they want to ride a wave of price. Well, the problem with that is that can often create pricing problems for builders, because as buyers panic and come into the market or get greedy and want to ride a price wave, when that becomes a large percentage of the reason people think housing is a good deal right now, we often see tops in the market. In fact, every time that total number of responses, rates are rising, prices are rising, or housing's a good investment, becomes 40% of the people who think it's a good time to buy, the market has begun to slow down. We saw that in 2018. What do we see now? Almost no one is saying that. Customers think it's a good time to buy because prices are low. That's a very positive sign for this business right now, and makes me a lot less worried about pricing and makes me less worried about a slowdown in demand. So this urgency index is great at picking tops. It's not great at picking bottoms, but we don't see anything close to a concern here in terms of prices rising to scare consumers or create fear and greed. So we did an analysis back in July where we tried to determine how much a home was worth to a consumer. How much value did the pandemic create? And what we determined through a fairly long piece that we wrote was that there are different elements of increased dollar value to the consumer. We determined that the average consumer in time and money saves about $59,000 a year not commuting to work. We also determined that if you look at the average square footage devoted to home offices, the rental equivalent in a commercial office building in an urban area, a halfway decent one, was about $28,000 a year. And the equivalent value of renting out a spare bedroom was worth $12,000 a year. So we compared the square footage to what you charge for it in the real world, office space or a rental bedroom. And then the commute was looking at gas, miles on the car, time saved, what that was worth to a customer. All of these things can get added back to the value of a house because this is what's happening right now. We're not commuting, so we're saving money. I'm utilizing my attic as an office. I'm saving money, not commuting. And if I wanted to rent out a bedroom, I could do so and get dollars for it. So all of these elements in our mind accrete to the value of a home. So in addition to increased value, we see supply shortages, and you're all feeling this across the value chain. Consumers initially, as pandemic hit, wanted move-in homes, but the supply of ready move-in homes, immediate move-in homes, spec, are waning really, really quickly. Consumers are going now to dirt starts. Demand's increasing for move-up and higher-end homes after having been low-end for quite some time. And we're seeing obvious labor and material supply chain bottlenecks. All of that is putting pressure on input costs and cash flow timing for builders. These are the new normal conditions for the pandemic and probably for 6 to 12 months beyond it. When does the pandemic end? We don't know. Basically, our models for the public home builders assume it ends sometime late next year. But we're basically looking at a period of time in which the supply chain will be choked, input costs will be high, but demand will be good for at least another year and probably more. It is important to note that larger builders do have an advantage when it comes to the rationing of input supply, basically materials, as I look at it. But even so, inventory for the nation for new homes has declined dramatically, 15% in the last 6 months. And we're now looking at near 3 months of supply in the market of new homes. And that's not homes ready to be occupied. That is homes under construction unsold, finished spec, and dirt on the market, meaning lots in a builder's community that has not been had a home started on it yet. And that's a much higher percentage of inventory now. So if we look at inventory available for sale and we divide it up into those 3 buckets, this orange line is finished spec, the dark blue line is units under construction spec, and the blue line is lots, but a home hasn't been started, not yet started. You'll see there's been a dramatic shift in the percentage of inventory in each one of those categories. We are really running out of finished spec fast and under construction units fast. So builders are trying to ramp their lot supply to replace that. But what that does, it creates a gap. It creates an issue in which builders are likely to be raising prices because they don't have product available for sale. And we think they're going to get them. This is what the existing housing market inventory looks like right now. And I chose this time frame from 2005 to now for a reason. This is the 12-month moving average of existing homes for sale. So let's go back to the height of the financial crisis in 2008 when we were looking at 3.7 million or so homes for sale, existing homes for sale. What I wanted to look at is where we were after the bubble, right at the peak of the bubble. 2005, we had just under 2.5 million existing homes on the market. Look where we are now, 1.5 million, 38% below inventory levels at the pre-bubble trough. That's a remarkable change. And again, that's hugely beneficial to builders generally and to prices. We talked about input costs, and builders know a lot, feel this more strongly than I do as a stock analyst. But one of the things that we've seen that's been helpful to us is that we now have a producer price index for residential construction goods, a basket of goods, not just lumber. So we know lumber prices have been really crazy. A lot of that has been due to mill shutdowns. That light blue line is is lumber futures, and we cut it off. It really got up even higher than this, but it's come back down to around this level. The futures market has been nuts. We have heard many tales of suppliers speculating on lumber, holding it and flipping it, crazy stuff. But if we look at the total basket of input goods, which include lumber, that we can track through the PPI, that's this dark blue line. Overall, the basket of input goods has been relatively flat since 2018. And we're hearing the big public builders talk about this. As dangerous as lumber price volatility is, and as important as lumber is, there are plenty of other goods that are seeing a little less cost pressure because the overall economy is slower. So I think it's an important thing to point out that lumber gets a lot of airplay, but it's not as important to the input cost base for many of the companies that we cover, the publics, as I think people perceive it to be. So the third point that we made in terms of our analogy was the war effort and government, how government can protect the home front. And it really comes down to two things. One is interest rates, and the other is home construction shutdowns at the state level. We don't expect those to come back. Home building's now an essential industry, and we feel very strongly that rates are going to stay low for a while. And so this is pretty simple. This is the Federal Reserve's governors and their projection of the Fed fund rate in 2020 and 2021. If we go back to the middle of 19, the projection for 20 and 21 was that Fed funds would be somewhere in the 2 to 2.5% range. Now it's zero for the foreseeable future. I think the Fed has made it very clear that they're going to continue to stimulate the economy as much as they possibly can and encourage Congress to do the same. And so again, how is this bad when we're looking at mortgage rates? The 10-year Treasury yield is this dark blue line, below 1% now for going on 6 to 7 months, and 30-year mortgage rates, which you all know, near all-time lows. So obviously this helps pricing power too when rates are as low as they are. And our expectation is they're going to stay roughly in that zone for a while. The fourth issue is rationing. And I think this is a really important point that oftentimes folks miss. Consumer spending options are limited right now. It's much harder for consumers to either do the things they used to do, spend money the way they used to spend it. And the more time they spend at home, there's confrontation with space limitations that they were able to ignore pre-pandemic. In addition, because there are many things that consumer cannot spend on, savings rates are increasing, and that means a faster accumulation of down payments. And so what I think is likely to happen is that housing affordability becomes less of a concern when consumers don't have expenditure option choices. And at the same time, that home is worth more to the consumer. Now, let me show you what I mean. So we looked at retail sales since the beginning of the year and the change in retail sales versus last year, so through August. And we broke it out into different kinds of things a consumer can buy. And that's all these little items down here. So clothing and clothing accessory sales are down 35% year over year, 35%. Restaurants down 21%. Gas stations down 17%. These are all expenditure choices. But if we look over here, non-store retailers, i.e. internet, right? And you've seen a lot of the stuff that's typically to the right side move over to the left side, meaning internet retail, and food and beverage stores, meaning grocery stores, and building material dealers, all up sharply year over year, while almost every other category is flat to down. So what we're seeing here is consumers cut back on expenditures on things like travel, things like clothes, things they don't need / don't want right now in favor of housing. And this is a data back from 2018, so it's a little bit old, but I just wanted to show folks sort of what element we could actually look at. So in 2018, average household income before taxes was $78,000. That's that top blue box. You pay about $11,000 in taxes, you have about $61,000 in expenditures, and you save $6,000 a year. So let's look at your expenditure bucket here. In 2018, the average household spent about $20,000 on housing, but $10,000 on transportation, $11,000 on other goods and services. These are areas that consumers could potentially be willing to sacrifice to pay more for the housing bucket. And we think that's what we're seeing. It's unlikely they'll pay less for healthcare. It's possible they'll pay less for food. Hard to believe they can pay less for insurance and pensions. But there's some flexibility in some of these buckets, particularly transport and particularly other goods and services, that could allow this dark blue section to expand. And I think that's exactly what's happening right now, because that's the option that we have as consumers. So the last point is this idea of refugees, de-densification. Unfortunately, the data on households moving and fleeing concentrated urban centers, well, it's limited. We don't have great real-time data for this. We know that anecdotally we're seeing high demand in small resort and second home markets. We know there's been a reconcentration of adult children living at home. So we've seen some anecdotal evidence of fleeing. But what we really wanted to look at was, okay, are there markets specifically that aren't small resort markets like in the Poconos or somewhere like that, that will benefit? Not Lake Tahoe, but cities, urban cities that could benefit here. And so we took a look at permit counts in all 367 United States metro areas. That ranges anywhere from Manhattan down to a very small town in Arkansas, and anywhere in between, 367 permit reporting jurisdictions. And what we found was that 22 relatively small cities that represented only 10% of total single-family permits were 40% of the growth in 2020 in permits. I thought this was very interesting. These cities are the ones that are most interesting to me because they are both in the top 100 largest cities in the country in terms of permits, but are also among the 100 fastest growers, growing at least 15% and a total of making up 40% of the growth. And here's who they are. And it's a surprising list. We're not surprised that towns in Florida like Daytona Beach and Port St. Lucie and Sarasota, we're not surprised that these are smaller cities growing very fast. But look at Gulfport and Killeen and Ogden Provo and Omaha and Kansas City. Right? Top 100 cities also growing at the fastest rates. Right? So these builders had to be in the top 100 of growth rate and the top 100 of permit size. So what we're seeing here, I think, is a focus on these smaller cities. Cities that weren't necessarily in the Sun Belt that everyone assumes grows, that are growing very fast and are still big enough to support decent sized permit count, at least 4,000 permits a year, or 3,000, somewhere in there. So I think these cities are very interesting, and very few public builders are in a lot of these cities. Some of them, there's plenty, like in Tucson, but a city like Omaha, some city like Kansas City has effectively almost none. These are really interesting places to watch carefully because they're attracting growth that they haven't attracted before. Okay, so that's our spiel on the wartime economy. The last slide or two are the questions that we get from investors and the questions I expect a lot of folks are asking right now. This is a war. There are plenty of uncertainty and plenty of fear. What are the fears? What are the things we need to think about in the future? There's really four things that sort of come out of my conversations with Wall Street types who invest in home building stocks. One is, are we going to see a wraparound white collar job loss? So in other words, we're not going to see the support for housing demand because jobs will drop among white collar workers. So far, we haven't seen that. Job losses are concentrated in lower paying sectors of the economy. Is this all a pull forward of demand, meaning rates are low, people are panicked, and we're going to sell a lot of houses now, but come 2021, we're not going to, or 2022 or later, we're not going to have that demand there. I mean, to some extent, I think that's true. But we're also seeing the beginning of Generation Z begin to move into the early stages of adulthood. And they may think very differently about housing than millennials did because they're living this pandemic. They're the ones being decamped. They're the ones leaving urban areas. They face different economic circumstances. They don't face the great bubble, the great housing bubble, the great recession the same way. They're emerging into a different kind of economy. So while there's certainly some pull forward, my guess is it's not as total as maybe others think. The third question is what happens after the election? Well, one of the things we know is there's a big difference and has been since 2016 in consumer confidence levels between Republican voters and Democratic voters. I'm going to show you that. And if we see a change in administration, it's possible that we could see a flip in consumer confidence between these two types of voters. That, since votes tend to be concentrated, urban core for blue voters, more ex-urban locations for red voters, though not everywhere, that could change the dynamic of housing demand. We could begin to see strength in places that had been weak, and we'll talk about that in a second. Then the last question, and maybe the most important to me, is what happens after we win? What happens when we've defeated the pandemic? We're likely to see consumer expenditure patterns surge towards what consumers couldn't have. But at the same time, job growth ought to help housing. So there's likely to be an offset. And I think the shift back to travel and clothes and other things, that's going to happen aggressively. But I don't know that it's going to create housing demand decline because we're likely to have job gains too. So just a couple of slides on that. So this slide requires a little explication, but this is job losses really since February by sector. So these big dots represent the size of a sector. So if you go all the way to the right up top, utilities is a relatively small sector. It's 1 million or 750,000 jobs or so, so it's teeny. But then look at education and health services, is 20 million jobs or somewhere in that general vicinity, right? So that's what the dots represent. The axis on top is average weekly wages. And the axis on the left is number of jobs lost since February. So what we can see here is that leisure and hospitality has been our big loser. About 4 million jobs lost since February. But the average leisure and hospitality wage is about $475,000. Other sectors like finance have lost relatively few jobs and is a pretty decent sized sector, but wages here are more like $1,300 a week. So what we've generally seen is a concentration in job losses that has tended to skew towards lower wage workers. So this could change. We could start to see some of these high wage jobs drop. But to this point, one of the things that's been helping housing is that we've really seen more weakness on the low end of the wage scale than the upper end of the wage scale. And my last slide is this, and we have looked at this many times since 2016. So this is the Bloomberg Consumer Comfort Index, which is sort of a proxy for consumer confidence by political party affiliation. Red is Republican, blue is Democrat. There's also one for independents, and it's kind of splits the difference between these two, really, the data. The big difference is what happened in 2016, right around November 2016, when blue consumer confidence flattened out and red consumer confidence skyrocketed. So the obvious question is, if we see a transition in administration in November, will these two reverse? And what does that mean for areas that tend to have a lot of red voters, which tend to be rural areas, tend to be the Southeast, both of which have been extremely strong housing markets, versus blue voters who tend to be more urban core concentrated, where we're losing jobs and losing demand for housing, and often have been on the coast where housing has been weaker. So this is going to be really interesting to watch if we see a change, in administration, if this data begins to change. It's just something to keep in mind. We're certainly anticipating that as we get closer to the election, traffic for builders will start to slow a little bit. That's typical. We've typically seen that near elections. So we should probably anticipate folks waiting and to see what happens post-election, especially this time around. But this consumer confidence stuff, I think, is really worth paying attention to. So it's a wartime economy. Home builders or defense contractors, we're benefiting. We're benefiting from what's happening in a way that I think is a positive thing. What we're seeing is folks believe that their home matters more to them and is therefore worth more to them. And that is, I think, a really important change that I think could carry on for quite some time. So Liz, that's what we have to say. Thanks everybody for spending time today. And we're looking forward to seeing you face to face again someday soon. And thanks for taking the time to listen today.